Don't let cheaper EMIs fool you. Every year, many of us begin with fresh financial resolutions. This year, I will save more. This year, I will reduce my EMI burden. This year, I will manage my loans better. But borrowers look ways for cutting EMIs, and lenders are quick to offer solutions. Lower interest rates, reduce EMIs, balance transfer offers, all of this sounds attractive. But here is a reality. Lower rates do not guarantee a good loan, and a cheaper EMI does not always reduce the loan cost. Hi, this is Mahesh Kadirvan, a debt freedom coach, welcoming you yet another session on how cheaper EMIs can fool you. Now, big disclaimer, this is video for education purpose only. It does not constitute any financial advice. Loan terms, interest rate, and eligibility may vary from person to person. So please consult a financial professional before making any financial decisions. Now, let me walk you through a few important checks that every borrower must do before taking or transferring on loan. First point, check affordability. Now, the first check is affordability. Affordability is not about whether the bank approves or that will be happening because bank is a business of giving the loans, right? But affordability in terms of whether your EMI fit comfortably in your monthly income, that's the question you need to ask. Your savings and investment can continue if affordability is there. If you can afford that EMI, that question you need to ask. You can manage your emergencies without stress. That affordability is there that you need to ask. So if EMI controls your lifestyle choices, then the loan is not affordable. Please note, because even if the EMI looks low, it doesn't mean that it can serve you better. It will always eat up your expenses. It will eat up your income and other equivalent expenses. Second thing, compare interest rates. The next step is to compare interest rates. A small difference in interest rates may look significant, but over long tenures, it changes the total cost of borrowing. Always compare more than just EMI. So I'm not saying that you need to look at the amount. You compare the interest rate, the tenure, the processing charges, the total interest paid over the loan period. If you see all these points also, maybe your EMI can, you have a different perspective of looking at. Third point, take insurance cover. Loans are long-term financial commitments. If something happens to the borrower and then the outstanding loan should not become a burden on the family, because that's why it is very important to have an adequate insurance cover, especially for the larger loans. Now, insurance should protect your family, not your increase your loan burden unnecessary. Now, there is a good marketing strategy wherein the home loan providers provide the insurance along with that particular loan. But please note that insurance cover will only suffice that loan only. So you can't use it for any other purpose, because if you're using that means the terms and conditions might vary. So you need to watch and check out that and consult your advisor for regarding to that. Next point, fix your credit score. Your credit score plays a critical role in loan pricing. A good credit score helps you to get lower interest rates, negotiate better terms, and avoid unnecessary rejections. And paying EMI on time and maintaining credit discipline can directly reduce the borrowing cost. A good example is that if you have a score of around 600 to 700, I'm not talking about 700 to 800, 600 to 7, that means a very good bargaining position you are in as a borrower to ask your lender, can it be considered for your loan pricing? Next point, keep the tenure short. Longer tenure makes EMI looks affordable, but longer tenure also means that higher total interest and longer dependence on the debt. Keeping the tenure short helps reduce interest outgo and speeds up debt freedom. And income grows, increasing EMI instead of extending the tenure, making a big difference. Now, what do I mean by that? I will share an Excel file post this. But the concept is that if you are looking for 27 years, that's the maximum years which the lender is giving you, that means you have a higher interest rate, that's the different thing, but you have a longer dependence on that debt. So in that period, If something happens to you, then that debt will fall, the burden will fall to your family. So it's always, and always a bit of concern also, ki when I'm going to do so, always in that concern that you have to pay your EMI, you have to pay your EMI. Now if that stress will be there, your health, your everything, the whole posture of your body will also get changed. So always keep the tenure short so that the reduce you can interest reduce outgoing and also speed up the debt freedom. Now I will share you an Excel file wherein I have showed that how a lender transfer the cost. Now there is very important thing in that key. A lot of times we don't do the calculations. Whatever the calculations are given by the lender or the bank, that's the only thing we look at. But I am sharing you an Excel file by which you can do it yourself and you can understand how it can be done. So I will just share you how we can do this. Now, if you see here, I have taken the tree. So current lender is this, okay, and a new lender and same lender EMI. Okay. Now you see what are the assumptions I have taken. The home loan is around 7.95, 7.35, and 7.35. Now a lot of times we feel that okay, the home loan rate is increasing. This good, but let's look at a different scenario. I have given three scenarios wherein you have a tenure of 25 years, another tenure of 25 years, and you have tenure of a EMI with the 21 years, and loan amount is same 50 lakhs, 50 lakhs, 50 lakhs. Now there's a one current lender, you gone for the new lender where the same EMI, and you gone with the two new lender the same EMI, but then you got a tenure less. Okay, now let's understand what is the EMI calculation you have done. So I've used the PMT function, which is a function which is used in Excel, so you don't need to worry about it. You just have to put these values and you can get it. So how much it is coming? It's coming around 38,425 per month EMI. Your for this where the 7.35 is the home loan rate and tenure is 25 years for 50 lakhs is around 36,463, and for a home loan of 7.35 21 years 50 lakhs you get 38,995. This is the EMI you are getting. That's clear for you. Yeah, that's the thing which the banker showed to you. Now what is the interest payable? Let's understand. So interest payable, if you see, is that 65 lakhs you are paying around 65 lakhs approximately you're paying for a 7.95 25 years of loan and 50 lakhs of 59 lakhs approximately if you see for 7.35 a rate 25 years and loan amount of 50 lakhs, and a 48 lakhs for 7.35 home loan rate and a tenure of 21 years. So which means that if you make the total of around in and around you will get 1 crore 115 lakhs. That's a payable you're getting, but actually you're paying over on interest. Is this is a major thing you need to look out, is 65 lakhs. And if you see the last column, this is the column which I was talking about, wherein you get the home loan. This is the ideal scenario in case if you see wherein home loan is 7.35, but you reduce the tenure by 4 years, just 4 years. You have not reduced anything. I have just reduced the 4 years and you get this much thing. So you're getting an interest savings of, if you see, 5 lakh 88,000, and you're getting this interest difference of 11 lakhs. This is the most important thing. 11 lakh 12,000 years savings actually, and that savings you can, this cannot be like measured, because once you get that statement and everything you can do that. But yes, but if you do this way you will able to understand what I am talking about. The tenure reductions months, if you do that by 21, and that will be the most important thing which you can realize. And okay, so interest saving will be around 48 months if you do it, and that will be the major thing. This is the Excel file which I wanted to share with you, and this Excel file will help you in doing the things which you feel it can be helping you a lot. Okay, very simple example. You can just put the values. I will share you this file. It will be linked in the description as well. You can check out it. Now, bonus borrowing traps to watch out for. Before closing, let me highlight you a few borrowing traps. Major of the borrowers are focusing only on the EMI and not ignoring the total interest. Always just ask the lenders what is the total interest I am eligible to pay. That's more important rather than the amount, because then you realize that how much, because what happens is that 15-20 years you're not paying the principal amount, you're paying actually the EMI amount. So if you get the EMI statement, you will always realize that, and you will see that your main things are going after 15 to 20 years. That means 15 or 20 years, you're still paying the interest to the bank. That means that's a problem, right? Extending a tenure just to feel temporary relief, yes, that's good, but that's a borrowing trap. Again, you get into the debt. Remember, is all about debt freedom. If you want to get out of the debt, then these things you have to get rest assured. Accepting bundled add-ons and insurance without understanding the cost, that's more important, because you are just the insurance, and now they're sticking it. They don't just tell you, they will always give us an add-on. They say that this is a very important, but you realize that premium is actually going and including interest also. That's also a component which is included with some of the lenders. So you have to better be careful what you're trying to say and what you're going to get it and what is committed, so that you can just see the terms and condition agreement, so that you can understand what is exactly you're getting into or stepping into. Refinancing repeatedly without checking whether the real savings existing or not. The top up loans and everything that comes into this trap again will get you into the debt. So you will never get out of the debt freedom. So always you have to feel that whenever I want to pay more loans or pay EMIs, is it that money is coming from my savings or my income or my salary? That's more the thing we have to do. Now, what appears cheaper today can become expensive over time. The lenders, the marketers will help you and will share you that this is cheaper than what you are getting this now, that all things will be there. But remember one thing, this will become expensive over the time, because when your expenses increases in inflation, increases in an urban city like Mumbai, Chennai or Delhi, Kolkata, that will be a big trap for you. Closing lines: cheaper EMI does not define a good loan. A good loan is one that is affordable. The affordable definition I've shared with you, which has a shorter tenure and helps you to move towards the debt freedom and finally towards the financial freedom. So if you have multiple loans or EMIs and want clarity how to reduce the interest and close the loan faster, I offer paid to paid one-to-one debt consultation. The link is in bio. In the description, where analyze your loans and create a practical debt exit plan. Now, this consultation link is in the description. Now, please note, this is not a simple process, and it will not a overnight success that you will get in 1 month or 2 months and 3 months. No, whatever plan I am sharing with you and whatever you are agreeing to, that you have to stick on it come what may happen. Because when you stick it, you get the consistency, and that will help you to get out the debt freedom much faster. So thank you so much for watching this video. If you're a new subscriber, please like it and subscribe, and see you in the next video with some other exclusive content on debt freedom.